Hey, what's going on, everybody? It's Wednesday, November 3rd. Got my blue shirt on. Somebody once said I look good with a blue shirt. All right, I put it on. Let's talk about the taper. Taper, they're gonna taper. They tapered. The Fed is tapering. Tapering. So, we got the much anticipated announcement today. Yeah, that the Fed was gonna taper. And so kind of a muted market reaction, although the stock market, all averages went up to new all-time highs. And let me just quickly state that is a function of fiscal support, which I've been talking about, and maybe I'll talk about it a little bit more in this video. But first of all, they're going to taper. So they're starting off with $15 billion a month. So right now, they're going to reduce their asset purchases by $15 billion a month. So $10 billion less treasuries, $5 billion less mortgage backed. Okay, if you take $15 billion, they're doing $120 billion a month. You know, if you divide that by 15 in 8 months at that pace, they'll be done. So like next June. Let's understand something here, and it is something like you're not going to hear this from other people, okay? Everybody, I just saw one video, you know, saying this is setting up the crash. The big crash is coming, all right? I don't pay, if you haven't noticed by now, I don't pay a lot of attention to monetary policy. You know, there are many people on Wall Street who delve deeply into monetary policy. If anything, what I talk about is, you know, things that are usually not discussed, or I talk about them way in advance before they become like known factors, like I was talking about here, and also, you know, in my report and the emails that I sent out, not just this year, but, you know, a couple of years ago, about the impact of all these massive reserves on bank balance sheets, and how that's an impediment to lending, and how that puts a lot of these constraints on banks because of the regulatory structure of things right now. Like, nobody talks about that. I'm the one who talks about that. I've educated a lot of you. I get a lot of thank yous from this about what, you know, the kind of insight that I bring. But anyway, so I don't, you know, sit around my screen waiting for that freaking Fed announcement. I don't give a shit. I'm sorry. But I mean, to me, again, I'll explain it one more time. The Fed is a bank. It lends against assets. It has the power to set interest rates, and by virtue of that power, it also sets inflation rates, which most central banks don't understand, because they think like low rates trigger inflation, but actually, because the cost of credit is reflected in the cost of all goods and services, when they lower rates, it makes credit cheaper. It makes prices functionally, essentially cheaper. And vice versa. I mean, you saw it very clearly when Paul Volcker, I mean, you maybe weren't even alive back then, but, you know, and I was just finishing my economics degree, but when he jacked interest rates up to 20%, what happened? Inflation went through the roof, all right? And we had an inflationary collapse as a result of that. I mean, he didn't squash inflation, he made it worse. And also at that time, if you know anything about what was happening at that time, you had a deregulation of the oil industry, you had a deregulation of the gas industry, you had major new energy discoveries in the North Sea, in Saudi Arabia. So you had this huge, you know, very positive from a supply standpoint of energy coming back on, and that squashed the whole inflation thing too. But anyway, I don't want to digress here. So the Fed is going to start with $15 billion a month. Let me again translate that, all right? First of all, that is functionally the same thing as the Fed leaving those securities in the economy. All right, rather than taking out $15 billion a month of securities, which the Fed earns money on, okay, like we got this cockamamie system where, and everybody thinks we got this national debt. I mean, the Fed owns like, what, 7 trillion almost of treasuries. The Treasury, the U.S. Treasury, the government pays the Fed the interest, and then the Fed just turns around and gives it right back. It's this stupid, hey, I'll take it out of one pocket, I'll stick it in the other pocket, then I'll take it back out of that pocket, I'll stick it in the other pocket. And everyone makes a big deal. Like the Fed could literally, you talk about the debt ceiling, I mean, the Fed could literally rip up those securities and then the debt ceiling will go down by whatever, 5.7, 5.8 trillion. But that's neither here nor there. So the taper, this 15 billion essentially will leave 15 billion of those securities in the economy. Fed won't be taking them out anymore, and those 15 billion, they earn interest. The Treasury pays interest on those securities, and that flows into the economy. That is payments. Those are payments. Remember, I talked about vertical and horizontal money. And vertical being the Fed, the government paying you, and you get it and you keep it and it's yours. And horizontal bank money, meaning like you get a loan and it's great, you get a deposit in your checking account, but then you got the loan, you got to pay it off, and you got to pay it off with interest. When they leave when the Fed stops buying those 15 billion, that's functionally the same thing as they leave the 15 billion in the economy to earn interest, and that is a money flow. It's like a fiscal, injection into the economy. So that's not a negative thing. It's not going to squash inflation. It's not a negative thing. And by the way, the whole inflation thing, if you saw crude down today, if you saw freight rates down again today, like all these things, we still have these people. The funny thing is, like I saw after the announcement, bonds sold off, gold sold off. Gold is doing its own thing now because Bitcoin has caught the attention really of people. A lot of people who used to be gold bugs are now Bitcoin bugs. And I'm not trying to say they're the same people. There's some of the same people, but again, my crypto explanation, is that, and I've said it so many times, I think it's the world seeking an alternative to a dollar-based global financial system because the U.S. has increasingly sought to weaponize the dollar, and it's just not going to work. Like, we need a unit that is not going to be subject to some group in Washington saying like, hey, you can't use this or you can't use this. It's an instrument, not just of foreign policy. I think it's an instrument of military policy too. Anyway, again, I'm getting off track. The bond market sell-off is silly. First of all, you have to understand one thing, that the Fed, in its statement today, didn't say anything about raising interest rates. Raising interest rates would be something. That would be unequivocally the Fed, the rate setter, the monopolist, telling you, hey, we're going to raise prices. They didn't say that. They just said, we're not buying that much. The other thing you have to understand, and I've said this so many times, but I think a lot of people don't understand this, and I see this spoken about, I see it written, rates are going to go up because the Fed is not buying. Let's just be clear on a fact that the Fed buys securities in the secondary market from dealers who have already bought securities at auction from the Treasury. And the money to buy treasuries comes from government spending itself. So you got the Fed sitting over here, okay? And then you got everybody else. You got the dealers over here. The Treasury auctions off a bunch of securities. The dealers buy. they have to buy, basically. That's their function, that's their role. They have to provide a market. They don't have to necessarily get filled on their bids. Maybe their bids are too low or too high or whatever. But they buy, and then later on, could be a few hours later, it could be days later, it could be weeks later, the Fed comes in and says, oh, you know those securities that you already bought from the Treasury? Like, we didn't give the Treasury any money or anything like that. The securities that you already own, can we buy some of those now from you? So, I mean, the price setting, unless it's a rate adjustment, okay, that's a different situation where the Fed literally says, okay, now the rate is X. Then everything adjusts. But this simple, buying of assets, I mean, this is so freaking misunderstood. It is unbelievable. So I'm not worried about this. Look, again, let me get down to the basic thing, which I know I say this every single day, and you're probably sick of hearing me saying it. You're probably sick of hearing me saying it. It's about the fiscal. The fiscal is very, very good now. As a matter of fact, I just looked today. It was, because the first of the month pumps it up, because to the first of the month you get stuff like, hang on. The first of the month you get stuff like military pay, Medicare, Medicaid, disability, veterans benefits. The first of the month is always like a huge payday. It bumped up that 10-day, remember I keep that 10-day average of daily flows. It's like at 29 billion right now. I mean, that's big, man. And I was really happy when we ended October with 518 billion. 518 billion is fine. So, bottom line is this. Rates are not going to go up unless the Fed says they're going to raise it, which they're not saying that. Prices are going to start to come down. I'm talking about commodity prices and things. You're already seeing it with oil. You're going to see it as the supply chain situation abates and dissipates. We're going to see prices start to come back down. And you see it in freight rates. I've been talking about this. All right? Don't get scared. Don't get nervous. This stuff is, we're going from a 6.5%, 7% growth rate to a 2%, maybe a 1.5% growth rate. Believe me when I tell you this. Prices are going to come down. Bond prices are going to go up. Yields are going to come down. The Fed is not talking about raising interest rates. The only cautionary thing I have to tell you, and I've been telling you this now for, a month, the end of this month, we're going to be back into this shenanigan fucking bullshit about raising the debt ceiling, and we don't have a budget. We're running on a continuing resolution. Now that could be a problem. If they don't raise the debt ceiling or suspend it, if we don't have, funding, here we go again with the government shutdown. You don't want to hit these flows. You don't want to hit these flows right now. You don't want to drag them down. But right now, everything is fine, folks. Everything is fine. No crash. You could get a pullback in the next couple of days because we get a little bit too bullish sentiment or whatever, like I talked about. But the monetary conditions they're just good. So smile. Have a good time. When stocks go down, you buy them. Look at Tesla up over 1,200. I stupidly got out at 1102, but I'll get back in. And so that's it. Don't forget, you got this month. Go to my website, sign up for a 30-day free trial. Try it. It costs you nothing. It's a 30-day free trial. It's going up to $1,250 a month on December 1st. Go to pitbulleconomics.com, sign up. And if you have hardship, if you have problems, if you lost your job, if you're a student, talk to me. I'm a reasonable guy. Talk to me. I want to work with you. All right. See everybody tomorrow. Bye. Don't panic. Everything's okay.